All right, let's get right into the tape for Monday, May 25th, 2026. Look, U.S. cash markets might be dark for Memorial Day, but let me tell you, the global futures board in the crypto space, yeah, they absolutely do not sleep. While the retail crowd is out firing up the barbecue, the institutional tape is actively putting in some massive structural shifts. I'm Steve, and in today's explainer, we're breaking down exactly where the smart money is moving amidst some pretty severe market hazards. So let's dive right in. Down 4.24%. Man, that is a raw, aggressive flush in Brent crude we just watched play out on thin holiday liquidity. It was violent, it was fast, and it absolutely sets an urgent, high-stakes tone for the entire week ahead. Look, when you've been trading as long as I have, you know that when a major macro asset class dumps like that into a closed cash market, you don't just brush it off. You got to look under the hood. A move this aggressive tells us somebody, somewhere, is getting caught totally offside, and they're just dumping contracts into a void of buyers. We need to figure out exactly why, and more importantly, how this is going to ripple across the rest of the board when that opening bell rings tomorrow. Let's run through the tape real quick and track the capital flow. Notice how S&P 500 futures are holding incredibly tight here, up almost a full percent at 7,559. But then you have that violent drop in Brent crude down to 94.55. Now pay attention to where the bids are stepping in. Spot gold just caught a seriously aggressive flight to safety bid, pushing up to 4,571. And Bitcoin, it completely shook off its weekend flush, climbing right back up to 77,503. Guys, capital is rotating hard right now. It's moving away from those speculative energy plays, and it is actively looking for a bunker. Whenever you see safe havens catching simultaneous bids alongside a steady equity market, it's a dead giveaway. Institutional managers are hedging their bets and bracing for impact.
Right now, we are operating in an absolute macro battlefield. It's a massive structural war between the bulls and the bears. On one side, the bull case is entirely pinned on corporate earnings resilience. They are betting that big tech innovation, massive cash reserves, and steady cash flows can basically bulldoze through any near-term headwinds. But on the flip side, the bears are screaming about structural stagflation. They're pointing straight at high consumer costs that are actively chewing right through the economy's foundation. It's your classic immovable object meeting an unstoppable force, and you know what? Something ultimately has to give.
And the massive engine driving that bear argument is the fixed income market. We are watching long-end U.S. Treasury yields absolutely surge, with the 30-year punching past 5% for the first time since 2007. I traded right through '07, and I can tell you firsthand, when risk-free government bonds start paying north of 5%, your equity risk premium compresses severely. Basically, you're getting paid significantly less to take on stock market risk. Think about it from the perspective of a pension fund manager, right? Why risk massive capital in a highly volatile stock market when you can just lock in a guaranteed 5% yield? If these long-end yields don't cool off soon, the S&P 500 becomes incredibly vulnerable to a sharp valuation correction. The bond market is literally the tail wagging the dog right now. Now, this fixed income threat ties directly into the shifting geopolitics over the Strait of Hormuz. Over the weekend, the paper market went into absolute panic mode. Algorithms dumped Brent crude hard on headlines suggesting a 30-day framework deal with Iran was close to reopening the shipping lanes. Look, algorithmic money is programmed to do one thing: sell the rumor instantly and ask questions later. They don't read the nuance, they just scan for keywords and aggressively hit the bid. That mechanical, relentless selling, combined with the sheer lack of human traders at the desks over the long holiday weekend, is exactly why we saw that brutal 4% flush on such thin volume. But we've got to separate the noise from the truth here. Let's look at physical reality. Iran's foreign ministry is already pushing back on those rumors. The blockade, it remains fully active. And most crucially, global inventories are still draining at an entirely unsustainable rate. The paper market sold a headline, but sticky energy costs are the physical truth of the matter. And those sticky costs are exactly what keeps forcing interest rates higher, feeding right back into that bearish stagflation thesis we just talked about. Until those physical barrels start moving freely again, any dip in crude based on political rumors is just noise. It's just noise masking a deep structural deficit.
Honestly, this whole situation brilliantly illustrates how the absolute best in the business handle market noise. Look at the Berkshire Hathaway playbook. Ajit Jain made it crystal clear that Berkshire has its price locked in to underwrite marine war risk for those stalled vessels sitting outside the strait. While other insurers are out there panicking, scrambling, and wildly shifting their rates based on weekend rumors, Berkshire just holds the line. They sit back on their massive cash reserves, and they wait for the market to price the risk on their terms. It's an absolute masterclass in protecting capital when volatility spikes. They never chase the tape, they let the tape come to them.
All right, let's pivot to the micro execution and break down these charts. Starting with S&P futures on the daily time frame. The bulls are fighting tooth and nail right now to defend the 20-day simple moving average at 7,550, really trying to establish that as a clear floor. But look right below that level. You've got the 50-day exponential moving average curling up near 7,410. For intermediate swing traders, that 50 EMA is our primary line in the sand. As long as we stay above it, the broader macro uptrend is technically protected. But if we start closing daily candles below that 50, the entire structure shifts. If that happens, you need to be prepared to get defensive real quick.
Shifting over to Brent crude, the moving averages here are screaming a massive warning. With that 4% algorithmic drop, crude just sliced clean through its daily 20 SMA. It is now resting dangerously, right on the edge, directly on its 50 EMA at the $95 shelf. If that $95 shelf fails to hold on a daily closing basis, the technical trapdoor swings wide open for a much deeper retest. We could easily see this thing flush all the way down into the 80s before finding any real institutional support. And let me be clear. If this technical breakdown confirms, it completely overrides all that geopolitical noise we just discussed. In this game, price is truth.
So let's bring it all together for tomorrow's opening bell. The bottom line is this. The structural trend is locked in, but those rising 5% interest rates are a major headwind that you simply cannot ignore. I am telling you right now, keep your risk tight, do not front-run these headline rumors, and definitely do not try to catch falling knives in this environment. Rely on your moving averages to tell you when the momentum has actually shifted. In this kind of tape, you have to let the market come to you, rather than chasing thin volume volatility. Capital preservation is always job number one.
Which leaves us with the critical technical question that is absolutely going to define the tape this week. Will the 50 EMA on both equities and crude actually hold when the heavy institutional volume returns tomorrow morning? That is your definitive line in the sand. Watch your levels, protect your capital, and I'll catch you on the next update.